European stocks have been on fire, so where specifically outside the United States do you like?
Well, really, when you look at valuations, even though certain aspects of the European market have gone up, and you see, the drug companies in particular that are involved in the GLP-1s, these things have gone up. But there's large areas within Europe, in particular, if you look at German industrials and European financials, that are trading at really, really low valuations. And these are businesses that have great exposure to what's happening all over the globe, not just in Europe, but in Asia and the United States. And what you see is similar to the U.S., where we have this bifurcation of certain sectors being at hugely elevated valuations versus other areas that are not. We're seeing this in Europe. But even when you look at Europe in its entirety, still trades at just 13 or 14 times earnings that are growing at 7 or 8%. And from a macro perspective, we're finally starting to see acceptable European macroeconomic growth, almost converging on the U.S. And some countries in Europe are growing faster than the U.S., like Spain and Italy.
So when do you anticipate those lower valuation stocks to catch up on performance? Because taking a look at the Oakmark International Fund, it's underperformed its benchmark MSCI World Index ex-US for the past 1 year, 3 years, and 5 years. So when should investors, you take a look at the headlines, you're seeing stocks at all-time highs, in terms of the Euro Stock 600, in terms of Japan. And so where's the underperformance, and what sort of environment do you need to see in order for those groups to catch up?
Yeah, clearly what you've seen in Japan is a euphoric market where the valuations have gotten well ahead of fundamentals. You have a market trading at 15 or 16 times earnings, and the corporate sector that could barely deliver on average a 9% return on equity. So, we're value investors at Harris Oakmark. We look at the price you pay for what you get. And one of the things that has hurt our short-term numbers has been an underweight in Japanese equities. And the reason we're underweight is because the value proposition just isn't there compared to other places. Places like Europe, or even in the U.S., incidentally, there's large parts of the U.S. market which are undervalued. But the value growth thing has hurt us. Growth is very overpriced in our view today, and the opportunity are in value stocks, and especially European value stocks. And then you overlay the currency where you have a dollar which is a bit stretched, which makes foreign stocks and their home currencies even looking more attractive, because you're able to buy low-priced businesses using undervalued currencies. Yes, as you point out, it's been a headwind. But on the other hand, I like to say is when the rearview mirror looks foggy, the front windshield looks quite good. And I think going through this period of weakness means we have a good future to look forward to, given where valuations are today and how we are positioned to take advantage of those low valuations.
So what makes the windshield look good, David? I'm wondering what sort of environment is it? A potential a global easing, coordinated easing cycle that will help these value stocks sort of get a jump start here and catch up to the growth.
It's more micro than that. Certainly you're going to see some easing. You saw the ECB cut 25 basis points today, but it's more micro than that. What I mean is corporate performance, cash flow earnings are growing high single digits. And we're starting to see, in Europe in particular, greater shareholder distributions. If you look at the percentage of cash flow that's going to shareholders in terms of dividend yields and buybacks, I think there's no place in the world where you see now more shareholder distribution proactivity as in European equities. And eventually the world's going to catch on that these businesses, European financials, European industrials, companies like Mercedes and BMW, BNP, Allianz, Intesa Sao Paulo, Lloyd, these companies are throwing off greater than 10% of their market cap in cash back to the owners. In an environment where people are still kind of searching for yield, especially in equity markets, these businesses are doing this exactly what they're supposed to do.